How many times have you heard a weather forecaster say that there's a good chance of rain, and then throughout the entire day, there's not a single rain cloud in sight? Yes, it even happens occasionally in the UK. In that situation, you may have interpreted the words "a good chance" as meaning that it's quite likely to happen. So you may have left your house with a big raincoat on, an umbrella in hand, and when there's no rain for the entire day, you might be frustrated and think that the weather forecaster always gets it wrong. However, what if the weather forecaster, when saying that there's a good chance of rain, was actually meaning that there's a 20% chance of rain happening? In their minds, that might be a good chance because 1 in 5 times rain is going to happen, so there's a good chance of it happening. But that's very different to your interpretation of it. This is something that was observed by Sherman Kent when he was the coordinator of information at the CIA in the US. So what he noticed was that the department, when explaining the chance of things happening, they were always using probabilistic language. So saying things like there's a serious possibility or there's a fair chance of things happening. One day he was discussing the term a serious possibility with one of his colleagues in the department. And what he discovered was that there was a big difference between their understanding of what that term actually meant. So Sherman decided to take that a step further and investigate throughout the entire department. And actually his findings from that little investigation were really quite concerning. So just with the term a serious possibility, the answers ranged from people thinking that meant there's an 80% chance of it happening, all the way down to a 20% chance of it happening, and many answers in between as well. So you can see that's a big difference between an 80% certainty and a 20% certainty. So considering they work for the CIA, it means that the analysts are going to be advising the president sometimes. So imagine a situation where the analyst says that there's a fair chance of success in a particular military action. They might be thinking that means there's a 30% chance of success. So 2 out of 3 times it'll be bad, but 1 out of 3 times it'll be successful. Whereas the president might interpret a fair chance of success, meaning that there's a 60% chance of success, meaning that 2 out of 3 times they'll be successful. Can you imagine a situation where that could be a disaster? So instead it became clear that instead of using probabilistic language, it was much better to use some sort of numerical system like a percentage. Now, although there was some resistance against using a percentage because they couldn't be that precise, it was definitely a much more conclusive way of getting across the point of how certain something was of happening. And this has also been adopted by weather forecasters as well. You'll often see, instead of them saying there's a good chance of rain, they'll instead say something like there's a 60% chance of rain. However, the problems don't stop there. Because if a weather forecaster does say that there's a 60% chance of rain, and then during that day it doesn't rain, we'll still tend to think that that weathercaster was wrong. We won't think about that 60%, we'll just think it didn't rain, that 60% figure was wrong. It may seem illogical to think that way, but we all do it with many things in our life. Now, when it comes to our trading, it doesn't matter if you're using a good system or not, or even what type of system you're using, whether you're using intuition or technical analysis or fundamentals, or if it's an algo system. It doesn't matter. At the end of the day, what you're doing is forecasting something. It doesn't matter how good or bad you are, you're still forecasting what's going to happen next. So with our trading, there's certain principles of forecasting that we need to understand and to incorporate into our optimization of our performance. So the truth is, when you're actually looking at an event, whether that's a trading setup or whether that's the weather for one day, when it's happening, you can't see the realities of the percentage chance of something happening because the actual event itself is binary. It's yes or no. Either it's going to rain or it's not going to rain. Either the setup's going to actually do what you expect it to or it's not. So you can't see that there was a 60% chance of something happening. You can only see whether it happened or it didn't. You see, it's just like what I said before. Because if you've got a trade setup that has a 70% chance of success, then if it doesn't do what you expect it to, you'll probably think that that trade was wrong, that the setup wasn't one you should have gone for. I see it all the time on the forums where someone takes a trade and they're saying, what did I do wrong? Well, not necessarily anything, because if it's a 70% chance, it still means that 3 times out of 10, it's not going to do what you expect it to. Now, the only way that we can figure out if these success rate percentages are right or wrong is to analyze them over time, and that's how we can see if they're accurate. And this is something that's really important for our trading. It's something we use all the time because the success rate plus the risk to reward ratio is going to tell us if it's a viable trade, and the success rate percentage on its own is going to help us to determine what the position size for that trade should be. So these are decisions that we make which are potentially make or break for a certain trade setup and make or break for our overall profit or loss over the longer term. But here's the thing, right? I mean, you've heard me say it before that we need to be collecting data about our trade setups so that over time you can look back and you can say, okay, this combination of factors led to a 70% success rate, this combination of factors led to a 50% success rate, and so on. So you can start to categorize which setups are viable, which ones aren't. So it's like a weather forecaster. You can identify that certain conditions are going to lead to a 70% chance of rain. So this is why collecting data and using it is really important to us, right? But hold on a second. Just because you've identified the certain conditions or the certain criteria that leads to a 60% success rate or a 70% success rate, and just because the weather forecaster has identified certain conditions that lead to a bigger chance of rain, like 60% rather than a 30% chance of rain, does that necessarily mean that in real time you're going to be spotting the conditions in the correct way to make the forecast in real time for the future of what's going to happen, rather than looking backwards and saying, okay, these conditions led to it? Yes, those conditions may still lead to a certain setup being a certain success rate in the future, but are you going to be able to identify it? So, in order to check this, to check the accuracy, I want to teach you how you can calibrate your forecasts and to see how accurate your forecasts are compared to reality. And this is something that weather forecasters do as well, and it's by utilizing something called the Breyer score. So, first things first. In order to be able to do this, you need to start tracking on every single trade exactly what percentage success rate you believe that trade to be. So when you're choosing your position size and things like that, if you're risking 1% instead of 0.5%, you have to say what you interpreted the success rate to be in order to make that decision. So was that trade a 65% certainty trade? Was it a 70%? Don't worry if you're not entirely accurate. This is going to be how we can calibrate over the longer term. And also do this for the trades that you don't take. So if there's a setup and you say, no, it's not strong enough for me to actually go for that trade, try and assign a percentage for it as well. Is it 20% chance of succeeding and that's why you're not using it? Is it 10%? Is it 30%? 50%, below 50%, assign a percentage to everything. You know, with our data of the setups, once they've happened, we can go back and find what the actual success rate percentage is, but we need to know what your forecast was. So instead of using the sort of probabilistic language in your head, like that was a strong setup, you need to say how strong. 80%, 85%, what is it? So take note of that for every trade, and every trade you don't take, every setup you see. And also then it goes without saying that we need to determine what actually constitutes success. So you might want to do a few different measures of this simultaneously. So for example, if I have a setup, is a success on that setup being that the next wave completes in my favor? Is it that it hits my target? Is it that the next candle moves in my favor? What is the determinant for success? Or possibly a few of them, and track them all individually so that you can actually have something that's an equal sort of gauge of how successful the trade setup was based on something that is going to remain the same. And once you have all of this data, you're going to want to plot it on a very simple chart. On one axis, you're going to show what the actual percentage success rate was, and on the other axis, you're going to show what your forecasted percentage success rate was. For example, check out this chart here. Now, this chart was taken from the book Super Forecasting by Philip Tetlock and Dan Gardner. You can see a picture-perfect calibration. When the forecaster said something was going to happen 60% of the time, it happened 60% of the time. So therefore, this chart is linear. Once you've started to plot your points on the chart, you can then see how you differ to the picture-perfect example, the linear example. So if you're above the linear line, like in this chart, you're underconfident. Your forecast for certain percentage success rates were lower than they actually ended up being. In this case, you might have been using smaller position sizes or even not going for certain trades, when in reality you could have had much more confidence in them, and this can really change your profitability. On the other hand, if you're under the line, then you're overconfident. You're predicting things have a higher success rate than they actually do. This means that you're probably going for trades that you shouldn't be going for because the success rate is too low for you to go for them, or you might be using position sizes that are too big. Now obviously, the more data you have, the longer period of time that you're collecting all of this information from, the bigger your sample size is going to be, and therefore the more accurate your calibration is going to be. The more realistic it will be of a picture of your forecasting compared to what the actual data was. And this can be really enlightening because it really starts to show you whether you're being overconfident or underconfident. But also there's something else that's really fascinating and really helpful, which is to use this data to understand your resolution. For example, if you are accurate but you're in the middle of the chart, then you're cautious but well calibrated. So of course this will give you some success, but it's not as impressive or as profitable as being decisive and well calibrated. And this can only happen at either end of the chart. So in these cases, you have certainty that a setup is not going to be successful, or certainty that a setup is going to be successful. So in terms of a decision-making basis, having an ultra-decisive level of resolution is going to carry higher risk, but also much higher potential returns. So you could put more at risk, which will bring you bigger returns, but you're also going to be hit much harder if you're wrong. So of course, in these ultra-decisive areas, it pays to be well calibrated. So what I think you should do is this. Start incorporating this percentage success rate, the forecasted one, with all of your trades and any setups that you see that might have been a possibility, and then also collect that data going backwards of what the actual success rate was. This is going to take some time because you need to collect the data, but it's going to be well worth it. And when you start plotting them on the chart, you can start to look at your calibration, and that means I can return to this topic in future videos and talk to you now about how to improve that calibration to make your forecasts more accurate, and therefore to increase your profit and loss because you're going to improve the position size accuracy and the setups that you're going for. It's going to take time, but it's so worth it. And by the way guys, if you do have your calibration charts, or when you have your calibration charts, then do feel free to send them over to me so I can critique it. I can give you some feedback about areas you might want to improve, or things you might want to change, or certain things you can start focusing on in your practice to make your calibration more accurate. But until then, if you've got any questions or comments, please do leave them below. Leave us a thumbs up, like the video if you enjoyed this, if you found it useful, if you want more videos like this. And don't forget to subscribe to the channel for more videos about learning to trade and about the financial markets in general. And of course, we have our 4-part video mini-series for you to learn all the foundations of our method of trading. It's free by signing up for our Inner Circle mailing list. The link's in the description box, along with all the links for us on social media. So there's plenty of ways for you to stay in touch with us and to keep on top of all of our content. As always, I really appreciate you watching. Take care, and I'll see you in the next video very soon. Bye.